Good evening, everyone. Thank you for joining me for our fourth quarter economic update. Today is April 1st, 2025. For those of you who don't recognize my voice, I am Ryan Herbert, one of the partners of Prostatis Financial Advisors Group, myself and Mike Kinnett. Let's go ahead and get started here. So, this is really, the team that we have of financial advisors. We have Andrew, Samantha, myself, Faisal, Catherine, and Lawrence. We are the main financial advisors of the firm. Today, really this is for informational purposes, not intended for any specific investment advice, any specific investment recommendation. Obviously, if you want to have a further conversation, 863-1040. If you have questions while I'm going along, please enter them in. If you're looking at your screen to the top right mark, you click on that little question mark box, and it should pop side menu. You'll be able to type your question in and go ahead and send it to me. I'll try to answer them as I go along. But if I can't get to it, or if I don't give you the answer that you're specifically looking for, please, feel free to reach out to me. You can email me, ryan@prostatisfg.com, or like I said, call the office, 410-863-1040. Right here, this is just something that I have been talking about for the past couple of these economic updates. Right now, the Tax Cut and Jobs Act is going away right now as the end of this year, and you can see the brackets are right now. The brackets we have right now are 10, 12, 22, 24, 32, 35, and 37. As soon as we hit 2026, they revert back to the Bush era tax cuts of 10, 15, 25, 28, 33, 35. 39.6. So the brackets are going up at the end of this year, and then how much income fits into those brackets. So right here, our 24% bracket is going to our 28% bracket, but you can see you get up into the 28% bracket a lot faster than you would get up into the 24% bracket, just based on how the income is. So something to be aware of. Right now, taxes are going to go up at the end of this year. So if we're doing Roth conversions for everybody, we'll be doing another one this year, and then we'll be adjusting the numbers in 2026. Another key part of it that everyone should be concerned of, right now, the lifetime exemption for estate planning is 11.2. It's adjusted up by inflation to about 13.6, I believe. After 2025, that number drops back down to 5 million. It'll be inflation adjusted probably to somewhere around 7.1, 7.2, which, it's not a huge concern for a lot of people right now. But, if your net worth is close to $4 million, including, everything you own and your house, well, then we really should be revisiting your estate plan, because over time, you would be approaching those higher numbers. I know Trump has talked about tax cuts. He's talked about a lot of different things when it comes to taxes, and I will kind of address that as we get into it. So really right now, everyone is really concerned about all of the volatility that we have seen since Trump was elected president, and, since therefore being inaugurated, with a lot of the actions that he's taking, cutting out a lot of the federal workforce in an attempt to save money to reduce government spending, and I think we can all agree that there is government waste in a lot of the spending that they're doing, but kind of the way that they're approaching the way to fix it is not the best tactic. And that really has led to a lot of this market volatility that we've seen. It's led to the tariffs that he's implemented, the tariffs that he's talking about implementing tomorrow. These reciprocal tariffs have led to a lot of market volatility. Obviously, we had a really good year last year in the stock market. This year we've given up about, the stock market's fallen back about, I don't know, 4, 5, maybe 6% so far. And so, a lot of you, that are in our portfolios, because I do have quite a few people who are attending who are not clients of ours, but, if you're in the overall portfolio, you've seen we've been making a lot of changes to the portfolio, dialing back our overall exposure. And the reason I've been doing so, the reason Mike and myself and the team, we've been making these changes is for the factors I'm going to show you, but also just the overall expected volatility that comes along with the actions that Trump is taking. So right now, recession chatter really has picked up for a lot of reasons, but, the uncertainty created by all the new policy changes, the tariff and trade policy, which, changes day by day, really depending what countries imports are being targeted and by how much. Adding to the stress is that, the U.S. is targeting large key trade partners like like Mexico and Canada, to which a lot of U.S. companies have a lot of exposure because a lot of the U.S. manufacturing is done. They get parts of their products from Canada or Mexico, or they're importing from Canada and Mexico. So there's a ton of exposure, and this concern over these higher tariffs really has led to a lot of the volatility that we've seen in the market. And what we've really seen is contraction. Looking at contraction in GDP, really a reduction of about 2.4% in GDP. We expect the net exports to fall because of these reciprocal tariffs that these other countries are really putting on there. Most of the weaknesses that we're seeing in this drop, like I said, is going to be exports. Really one thing, another aspect that we've seen is that imports really ramped up in the first quarter, basically reflecting the fact that consumers are expecting these tariffs to kick in. They're expecting these tariffs to flow through to higher prices. So they were trying to buy everything they possibly could that they needed prior to these things kicking in. And this GDP thing, this is a forecast. This is not a guarantee. We just ended the first quarter of the year last year, so GDP numbers should be coming through soon. But I would expect us to see a rather significant decrease in GDP of right around 2.5, 2.4%, and that's kind of what this forward-looking chart was looking at. This was from earlier in March from 2025. Partly, most importantly, we really haven't seen too huge of a drop-off in consumer spending or business investment in the first quarter, and that just really means that there was demand for that aspect, because a lot of people were buying all the things that they wanted to buy ahead of these tariffs coming out tomorrow. There are still, so while demand for certain items still has remained strong, there are some cracks that are showing, and we certainly are going to see that. One of them being, a recent spike in job cut announcements. The announcement of job cuts soared right here, to about 173,000 in February. A lot of it has to do with the massive layoffs that the Department of Government Efficiency is trying to really reduce that federal workforce and reduce it swiftly. And historically, when we look back at how recessions really coincide with job cuts, it really tends to be kind of happen towards the back end of the recession. We see this here, the 2001, 2002 recession, the job cuts started to soar, and then they really peaked, towards the back end of it. Same thing in 2008, 2009. The layoffs happened in 2009. 2020, same kind of thing. It was a much shorter time frame, but is this an indicator that the recession is coming? Not necessarily. but it is one of the indicators that we are looking at that triggers us to think maybe we really should start trimming out some of the overall risk exposure that we have in the portfolios, start moving out of the equities into fixed income, cash, and alternative investments. And that really has been what we have been doing with the overall portfolio since kind of the start of the year. You know, these increased recession fears have kind of been reflected in the leaders of the stock market. You know, over the past year that we've seen, if we go from March of 24 to March this year, consumer discretionary sector is now underperforming the consumer staples sector. You know, the decline that we've seen in consumer discretionary really has been driven by Tesla. You know, the demand for Teslas, people were buying a lot of them for electric cars, but then as soon as Elon Musk started doing everything that was going on with the government and Doge, the demand for those fell off. And so really, you know, that magnificent seven that we've seen really propel the stock market all of last year, two of the big drivers of that being Tesla and NVIDIA. So since the demand for Tesla fall off, we've seen that consumer discretionary spending really fall off pretty substantially. You know, but consumer staples, this is this yellow line. This is the discretionary items that people buy: TVs, furniture, electronics, cars, things of like that. Vacations, fast food. Those are cut when household budget slowing of the. What we've seen is a consumer discretionary spending, while consumer staples has set up, because these are things that people continue to buy regardless of whether we're in a recession or an expansion part of the economy, because these are things that, you know, food, laundry detergent, cleaning supplies, toothpaste, the things you have to buy no matter where the overall economy is. We really have seen bond yields start to come down over the last 6 to 8 weeks as investors really focus on the growth that we've seen really starting to slow down. That's kind of what we've been focusing on. The tariffs really have dampened any type of economic growth and investment that we might see. Cooling in the labor market really kind of is shifting things to really being cautious of inflation. If these tariffs go into effect full force, like he's talked about, we are going to see inflation start to kick back in. The Federal Reserve raised interest rates so many years ago, not so many years ago, over the past couple years, to try to reduce the inflationary numbers. And it's kind of fallen back off, but now inflation really kind of has, the inflationary numbers really kind of have stalled. So what we see here is the ISM survey. We're comparing ISM manufacturing to ISM new orders and ISM employment. You know, this is released once a month, so the data has not come out yet from March, but this is our data from February, and this is kind of a year-over-year, a year look here, the monthly data, indicating weakening conditions overall from, you know, weakening manufacturing, weakening, and I just got to move this one thing out of the way here, weakening new orders, weakening employment. Basically, you can see things start to fall off here. We were doing fairly well, and then things started to fall off, and now it's kind of really started to fall below that 50%. A score over 50 indicates that the industry is expanding, and, you know, anything below 50 shows a contraction. So right now we are kind of in a contractionary period when it comes to the manufacturing and employment and manufacturing new orders. The question here is, what is ISM? ISM simply stands for the Institute of Supply Management. It is a survey organization that measures the manufacturing indexes, the manufacturing conditions overall in the United States. And so what we're seeing here is that manufacturing is kind of starting to fall off because they're expecting prices to really start rising. So they don't want to be ramping up their production when their costs are going to start going up here. The labor market really at this point is starting to show signs of softening. Job growth really has slowed, and the participation in the labor market has started to fall off. The unemployment rate, on the other hand, has held pretty steady, but the underemployment rate, meaning the number of looking for full-time work and can't find it, has jumped up as well. And what we see here is the labor force participation has kind of started to fall off here, and the prime age labor force, the people who are in the prime of their careers, has started to fall off as well. Now, really what we're seeing here, this is our unemployment rate. It's held pretty steady, right around 4% since February of 2022, and into the first couple months of the Trump administration has held pretty steady, right around 4.1. But now what we're starting to see, like I said, is that underemployment rate. The people who are looking for gainful full-time work are unable to find it, so they're taking, jobs paying less than what they used to pay before, or half-time work, or in a completely different industry or area of expertise are taking those jobs. That has started to tick up. The Federal Reserve signaled that it's going to keep interest rates on hold. Inflation is really stalled above their 2% target rate, and since these tariffs are going to come in and really raise prices, that's going to start to push inflation up a little higher. But I still think that there is potential for the Fed to start cutting rates towards the end of this year. The Federal Reserve, the study that it does is called the Beige Book. It provides a review of certain economic conditions, indicates that a lot of businesses really are concerned about the impact of tariffs on their sales, but also their cost for them to acquire the products that they're selling. And it really has started to have a negative impact on businesses investing in themselves, business investing in their manufacturing, trying to ramp up their production. If unemployment really starts to rise, that really will trigger the Fed to start to lower rates quicker, sooner on this year rather than later on this year. And that really is even if inflation stays above its number there. If inflation starts to creep up, but employment starts to creep up, they're going to have to start cutting rates, regardless of whatever inflation is doing. All of this really kind of comes back to what we have been looking at in the overall portfolios. Everyone has known that there's been a lot of volatility in the market. March particularly being, kind of a terrible month for the overall stock market. You've seen that we've been doing overall trimming in the portfolios, moving out of the equity positions, reducing our equity exposure, moving to fixed income, moving to cash. Right now, when we think about our overall portfolios, and when I say overall portfolios, it's not just the money that we have at Charles Schwab. It includes those annuities that we bought in replace of bond positions, because those annuity positions really are our fixed income, because the whole goal of having safety when it comes to bonds or fixed income is that when the stock market goes down, my money is protected. And that is exactly the strategy that we have chosen to take by using these annuities, those fixed index annuities, either with North American or Delaware Life or Gillico or Security Benefit, just to name a few. The whole point of those is stock market drops, I don't lose anything. Stock market goes up, I make money, but most importantly, stock market drops, I don't lose anything. When we look at the combined nature of your portfolio, including those annuities, our overall exposure for most of the clients is about a 50-50 allocation, 50% equities to 50% fixed income, which is a fairly moderately conservative portfolio, but almost hedging towards that 40% equity, 60% fixed income, very conservative nature. So we are taking really protective measures in the overall portfolio, and the results, I believe that we're down about between 3 to 3.5% so far for the year, where the overall market's down about 5 to 5.5%. So we're really trying to reduce our downside exposure is one of the big tactics that Mike and I have always chosen. It's not how much you make, it's how much you keep at the end of the day. And the portfolios really are set up and designed to give us this protection, because whenever you have volatility in the market, you want to have a plan that accounts for this volatility. Because whenever the stock market's going up, it's great. Everyone feels great because you basically pick something in the stock market and it's going to make money. Really, the part that makes everyone feel nervous is times exactly like this, when we don't know exactly what is going to happen. Question here is for me to repeat the target proportions. Right now, overall portfolios, when you're looking at the annuity positions that we have compared to what we have at Charles Schwab, ideally we're somewhere between 50 and 50, 50-50, 50% equities, 50% fixed income, or 40-60, 40% fixed, 40% equities, 60% fixed income. There are a few clients that are more conservative than that, and we have a few clients that are much more aggressive than that. But for the most part, that's where most of our clients are falling. And if you have questions about, what your particular portfolio looks like, how conservative you have become, if you want to become more conservative or make adjustments, give the office a call. Talk to your advisor, whether it's Catherine, it's Sam, it's Faisal, it's Ann. I would say with one caveat, at this point, it is tax season. So Catherine, myself, and Andrew and Mike were really, really busy with a lot of the I forgot this one little piece, turn, that type of thing. So our response time is a little bit delayed, but you can always call and talk to Lawrence, you can talk to Faisal, you can talk to Sam, or even talk to Vanessa or Brandon or Kimberly. Any one of our service assistants are more than happy to help answer your questions. But the most important part is that at Prostatis, we have a plan. We built our portfolios to give us the downside protection in market times like these. And I think that we're going to have this continued volatility for the foreseeable future. Really, the one thing that I think is going to give us some stabilization out there in the overall market is, Trump talked about extending out this Tax Cut and Jobs Act and making it permanent, meaning that it's not going to expire at the end of the year and it's permanent till the next administration changes. I think he does that. That happens. That gives us stabilization in the market, and we won't have all this up, down, sideways movement, possibly even some positive movement, because now I'm going to have more money in my pocket, because my taxes are not going to go up. The same thing if he decides that he's going to eliminate the tax on Social Security, or he's going to limit the tax on tips or overtime. Those are all positive things to give us some stabilization in the market and allow the stock market, allow the economy to have kind of some ground footing to kind of move on from. One of the all this gloom and doom that I talk about in the United States, everything that's going on, one of the biggest surprises that we've seen really is, the European stock market. Germany, the largest economy in Europe, their stocks are up almost 20%, compared to everything else. Economic data in the Eurozone is really exceeding expectations this year in Europe. While the U.S. is missing on its expectations. We're seeing interest rates cuts in Europe. We're seeing interest rate cuts from the European Central Bank, which is really helping their market. What we see here is just, the economic surprise index, not really expected to come out of the Eurozone. Meanwhile, this is kind of what we pretty much expect with the United States. So this is just something to be cognizant of. This is one area of the market where we are, still maintaining our exposure. We're not trimming out of there because those are the areas that are outperforming at this time. But most importantly, at Prostatis, we are monitoring their portfolios, we are taking changes, and we are always here to answer any questions that you might have. If you want to have conversations with myself or Catherine or Sam or Faisal or Andrew or Lawrence, any one of my advisors, please just pick up the phone. More than happy to have those conversations. More than happy to talk about if you still have money in your current 401k, because you're still working and we can't help manage the assets there. More than happy to have conversations about here's how you could shift the funds around to take a much more defensive strategy if you want. And that really is pretty much what I have had for this evening. I hope everyone found the information useful. I hope everyone found it understandable. I try to make it take the various economic factors that we consider when making our portfolio decisions and try to explain it in a very simple way so everyone knows kind of what's going on and what we're doing, why we're doing. But like I said, if you have questions, give me a call at the office, 410-863-1040, 410-863-1040, and we'll be more than happy to have those conversations. We are here at the end of tax season, so we have 15 days left. So we're really making this really hard last push. If you have all of your tax documents in with us and you haven't heard anything back, please be patient. I know that Iva and Scott and Catherine and Andrew all are diligently working on tax returns. They have quite a few to go, but the goal is to get them all done by April 15th. But if you have questions, give us a call, 410-863-1040. General recommendations for 401ks. I can't really go into specifics about generalized recommendations. I think that there's going to be volatility for the year. So if you're concerned about the balance of your 401k, it might be time to take some money off the table, take some money out of equities, put it into maybe some of the fixed positions or even the stable value positions. But that really is a one-on-one, very situational specific conversation, because while I'm 40 years old, I certainly have plenty of time to recover should my portfolio drop 10 or 15%, but probably not the same as somebody who is in their 60s and looking to retire next year, probably not able to take on that same type of risk. So the recommendation I would give would definitely be different. Am I suggesting not investing in equities? I'm not suggesting not to invest in overall equity. Just be cognizant of a lot this volatility that's going to be there. It's not going to be what we have seen over the past 3 years where the stock market is just on this upward trajectory. There's going to be good days, there's going to be bad days, there's going to be so-so days. There's going to be a lot of volatility, and you really just have to determine how much risk are you willing to take. There are certain areas of the market that perform well during recessionary periods. There are other areas outside of the U.S., like I just showed, the international markets that really are outperforming. I really am just saying we need to be cognizant, you need to be cognizant of the risks that you're taking inside of the portfolio. Let's see. So there's no more questions that I'm seeing here. But if you have any additional questions, please feel free to email me directly, Ryan, R-Y-A-N, at Prostatis, FG, F is in financial, G is in group.com. More than happy to answer those questions. But I would like everyone to have a wonderful evening. And I look forward to seeing everyone in the office for our reviews after tax season and after the office gets to take a nice little breather. But thank you everyone for joining us, and I hope everyone has a wonderful evening.